After an exceptional year in 2023 for equity market, the rally is continuing at the start of 2024. Some of the main indices have even reached all-time high, such as the S&P 500, which have exceeded for the first time in history 5,000 points. Given this context, is it still the right time to be positive on equity? Let's answer that question with Laura Corrieras, Equities Manager at Indosuez Wealth Asset Management. Good afternoon, Laura.
Good afternoon, Nicolas.
So, Laura, let's start with the economic environment. There was a lot of talk about a hard landing scenario in early 2023. It was probably the most expected recession of all time. And finally, this catastrophic scenario didn't happen.
That's right. In 2023, we went from a risk of hard landing to expecting a soft landing. In the end, a no-landing scenario consisting of further economic growth is now well anticipated. We have revised our outlook for the US growth for 2024 to 2.3% above consensus. Economic data remains resilient overall in the US, thanks in particular to consumer health, which is still very solid. And in the meantime, productivity gains should contribute to support businesses over the coming years. And at the same time, Nicolas, we are seeing that the trend of the current disinflation continues to slowly converge towards the Fed's 2% target. We will be probably around this level by the end of the year. This is a context that we feel is promising for the equity markets.
That's right. This is a situation that the market calls Goldilocks, in which the economic environment is just at the right level. There isn't too much inflation or growth, neither too little, and central banks can finally reduce their rates. It's the rate cuts that we see starting in Q2. We expect 100 basis points of cuts synchronized between the Fed and the ECB by the end of the year. This environment, which allows companies to pursue their growth and in the same time enables central banks to reduce their financial pressure, has traditionally been quite supportive for the equity market. Historically, we have seen average performance of around 9% for the S&P 500 in this type of context. So finally, this Goldilocks environment should keep the bears away from the market for some time. Another reference to the children's story. By the way, Laura, aside from this overall positive trend, what will be the themes that will propel the market this year?
It's true that in 2023, it was mainly the Magnificent Seven that drove the performance of the US market. This trend should continue due to the technological domination and the ability to invest in the research and development programs thanks to the massive amount of cash to maintain this technological lead. We also note that the earnings and sales forecasts for 2024 are twice as high as the rest of the market. However, we believe we will need to be selective this year.
So the technology sector is still attractive. Are we seeing other opportunities in other sectors?
Of course, yes. Firstly, other key players in AI, in addition to the Magnificent Seven, will be among the next great leaders. We are also identifying opportunities on other terms with structural trends, such as the acceleration in the ecological transition, which is becoming a key issue from an environmental, economic, and regulatory standpoint. Lastly, in a year when over half of the population will be heading to the polls, the subject of reshoring, defense, and cybersecurity will be for sure a central concern. Remember that the priority of investment spending for businesses is by far IT security, with 89% of chief information officers plan to increase spending in 2024, followed by AI and the cloud. And it should be noted that the US is still our preferred area for identifying these future major technology leaders, and we still favor this region for this viewpoint, although there are also interesting alternatives in Europe.
In Europe, the focus is more on quality, with players in sectors such as luxury, healthcare, consumer staple, and even technology. These stocks are sometimes grouped together under the acronym GRANOLAS. These are 11 shares, including Glaxo, ASML, Novo Nordisk, and SAP, and which are a bit like our European Magnificent Seven. These companies are the biggest market cap of the European Stock Exchange and are notable for their quality profile. They have above average earning growth, high margin, and pricing power thanks to their dominant market position. That's the case, for example, of Novo Nordisk in the obesity segment. Of course, the European market isn't limited to these 11 shares, and there are still a lot of other opportunities, but particularly in the value cyclical segment, which remains undervalued overall. We equally think that the small and mid caps could benefit from renewed interest during the year. Valuation discount level have reached a more than 20-year high in absolute and relative terms compared to large cap, and the drop in financing rate is putting pressure away on many capital-intensive shares. In this segment, we believe we should already come back on the US before returning to Europe. We've just discussed Europe and the US. What's the outlook for the other markets?
On emerging markets, we recommend a holistic approach. Asia, excluding China, looks well positioned for 2024. Valuation is half the US for almost twice the expected earning growth, and investor positioning is still low. On a more micro level, tech leaders in Taiwan and South Korea, for example, are key to the global AI supply chain. In India, the emergence of a middle class and the young population of ASEAN are attractive growth drivers that should boost domestic consumption and the infrastructure segment. We are keeping a moderate exposure to China, as weak domestic demand and ongoing tensions in the real estate sector remain a concern.
To conclude, there are still opportunities in 2024, and the environment will remain generally favorable for equities, driven by central bank rate cuts and resilient growth. Selectivity will be key, as the pivot by central bank is often accompanied by major style rotations. While we remain well positioned on the quality growth base and on the US market, sources of opportunities and diversification will undoubtedly present themselves during the year, and we will need to start preparing for them now.